Okay, let's dive right into this explainer and unpack a truly fascinating, data-driven mystery. We're looking at Abercrombie & Fitch's current market valuation today. Now, if you follow retail stocks, you know the market can be, well, incredibly fickle. It swings wildly between extreme optimism and punishing pessimism. But honestly, rarely do we see a disconnect as wide, and frankly as puzzling, as the one currently sitting in the data for Abercrombie. Today, we're going to use the raw numbers to illustrate what is literally a textbook paradox. We are going to put what the stock price is telling us right up against what the actual business fundamentals are screaming.
So take a look at this absolutely brutal number, negative 43.93%. That is Abercrombie's year-to-date return. When you see a stock essentially cut in half in less than a year, your immediate assumption is usually, wow, this business must be collapsing, right? A drop this severe reflects extreme, almost panicked short-term market pessimism. It signals that investors are just rushing for the exits, terrified of what the future holds for this retailer. But wait, right next to it, we have this massive 3-year compound annual growth rate for net income, positive 462.15%. Let that sink in. And that right there sets up our central paradox, a plunging stock price colliding head-on with soaring business performance. I mean, how can a business that's growing its net income at over 400% annually over a 3-year stretch get punished with a 44% year-to-date stock drop? That is the exact mystery we're going to unravel together.
Okay, let's move into Section 1, the recent stock plunge, just to set the stage.
The stock has been absolutely crushed lately. We're looking at a current price hovering right around $70.57. But the absolutely crucial context here is that this is trading nearly 47% off its 52-week high of $133.11, which it hit just earlier this year. Think about that swing for a second. Within a 52-week window, the market went from valuing this company at over $133 a share to barely $70. This wasn't a slow, gradual bleed. This was a massive, aggressive repricing by the market.
So let's zoom out a bit. Section 2, a 3-year turnaround story.
Looking over a 3-year compound annual growth rate, Abercrombie has delivered really solid double-digit revenue growth at 12.46%. But look at what happens as we move down the income statement. This is where it gets good. Free cash flow is growing at nearly 62%, and earnings per share is expanding at over 76% annually. This means the business isn't just pushing out more clothes. They are becoming exponentially more efficient at turning those sales into cold, hard cash and actual profit for shareholders.
And here's the kicker. Profit margins haven't contracted, they've actually expanded significantly. When we compare the most recent trailing 12 months to the 3-year average, the net profit margin has jumped from 8.37% to 10.47%. Now, in the hyper-competitive retail apparel sector, squeezing out over 10% net margins is incredibly difficult. This proves for sure that their explosive net income growth isn't just some pandemic-era fluke, it's driven by structurally improving profitability.
All right, Section 3. Flawless financial health metrics. Let's look under the hood.
These incredibly high-return metrics point directly to a highly efficient management team. Let's really focus on that bottom number for a second. Return on invested capital, or ROIC, sitting at 31.51%. What that means in plain English is that for every single dollar of capital this company invests back into its business, it generates exceptional returns, over 31 cents on the dollar. Meanwhile, an ROE of over 36% shows they are just generating massive value for shareholders' equity. Honestly, these are the kinds of numbers you typically associate with high-flying tech monopolies, not a mall-based apparel retailer.
Now, this might be my favorite part. Look at the debt-to-equity ratio. It is literally zero. Zero debt. This means this thriving business carries practically no long-term financial risk. In an environment where interest rates have been a major headwind for companies carrying a lot of leverage, Abercrombie is entirely immune. They have no massive interest payments eating into those beautiful margins we saw earlier. It is an absolute fortress of a balance sheet.
Which brings us to Section 4, crunching the valuation multiples. How is the market actually pricing all this success? Well, it's wild. The market is currently valuing this high-performing company at an absurdly low multiple of just 6.7 times earnings. Remember, the 3-year average PE for this stock is 14.9, so the current valuation is down 55% from its historical norm. On top of that, you can buy this business for a fraction of its sales, a price-to-sales ratio of just 0.60, and an enterprise value to EBITDA of 2.65 is essentially basement-level pricing. These are multiples you normally assign to a dying business on the verge of bankruptcy, not a completely debt-free company with a 31% ROIC.
And to put that into perspective, look at how much cash the company is throwing off relative to its depressed stock price. A free cash flow yield of 12.01% is absolutely astounding. It essentially means that if you bought the entire company at today's market cap, it would generate enough free cash to pay you back at 12% yield in the very first year. Plus, this current yield stands 34% higher than its 3-year average. It is basically a massive neon sign pointing to value.
Finally, let's tie it all together in Section 5, Intrinsic Value and Safety. This visual gap right here perfectly illustrates the central theme of price versus value. On one side, you have what the market is asking you to pay today, $70.57. On the other side, based on discounted cash flow metrics, which is just the calculated value of all the cash the business is estimated to generate in the future, the fair value sits at $123.91. This highlights a massive, glaring upside between the current pessimistic market price and the objective, mathematically derived intrinsic value of the business. Because of that huge gap, investors are currently being offered a massive 43.05% margin of safety. This is a classic investing concept, and a margin of safety this large heavily cushions any potential downside. It means that even if Abercrombie's growth slows down a bit, or if there's a broader economic recession, the price you're paying today is already so deeply discounted that you have a massive buffer protecting your investment. The market is already priced in a total catastrophe that the fundamental data tells us simply isn't happening.
So given the flawless fundamentals we just walked through, the zero debt, the surging free cash flow, the expanding margins, and contrasting all of that with a crushed stock price trading at less than 7 times earnings, we want to leave you with this final thought to ponder. When you look at this incredible data discrepancy, what do you see? Is there some hidden flaw making Abercrombie a classic value trap, or are we staring at one of the market's most glaring mispricings? The data is laid out right before you. Now it's up to you to decide how to interpret the great Abercrombie paradox. Thanks for joining us for this explainer.